Stocks have been continuing to fall on international trade war developments. Yesterday, the EU put a 50% tariff on whiskey from the United States, and Trump responded by saying he will shortly place a 200% tariff on wines, champagnes, and alcohol products coming out of the EU. This is further straining international relationships and causing more uncertainty in the global economy. This has caused Google, Microsoft, Amazon, and Apple to continue to fall. And in this video, we will be discussing their valuations today. We will also be discussing if Adobe stock is looking cheap after falling 14%, a new bearish article that came out on Brookfield, and a new Bruce Flatt interview. Before we get into the video, I want to let you all know that this video is sponsored by Hamilton ETFs. Hamilton is one of the fastest growing ETF providers in Canada, and now has over $7 billion in assets under management. They also recently launched a new US dividend ETF with the ticker SMVP, which tracks the selective United States Dividend Elite Champions Index. This index is an equally weighted portfolio of US companies with at least 25 years of dividend increases and no dividend cuts. The selective index that SMVP tracks has also been more resilient since the S&P has started selling off. It's down about 2.6% over the past month versus the S&P's 10% drop now. Historically, it has also outperformed the S&P 500, producing annual returns of 10.7% versus the S&P's 10.5%. However, it's also produced higher dividend income, less volatility, lower drawdowns, and faster recovery times. So all around, this index seems to have matched the S&P's returns with more income and less volatility. What's also interesting is SMVP has a lower weighting to tech at only 6.3%. This means the ETF's returns are less reliant on tech stocks continuing to perform well. Hamilton believes that this ETF is great for investors who want a diversified portfolio of US dividend growth stocks with strong historical performance. They're also offering a 0% management fee on SMVP until January 31st of next year. And for those of you who are interested in modest leverage to boost potential returns, Hamilton also has SWIN, which tracks the same index just with 25% leverage. So if you're interested in checking out Hamilton's new ETFs, then click the link in my description and make sure to check out Hamilton's website. So now let's hop into the video and let's start off by discussing Adobe stock. So as I said, Adobe did fall about 14% after it reported earnings, and the stock is recovering slightly today, but it is still down over 30% over the past year. And a lot of people have asked me to take a look at Adobe stock after the earnings, so let's go and pull up the highlights from their most recent report. And I have some screenshots here. So here we can see that Adobe reported record Q1 operating cash flows of about $2.48 billion. They also reaffirmed their 2025 guidance. Then they say, Adobe is well positioned to capitalize on the acceleration of the creative economy driven by AI, and we are reaffirming our fiscal year 2025 financial targets. For the first quarter of 2025, Adobe achieved record revenue of $5.71 billion. GAAP operating income also came in at $2.16 billion, and Adobe repurchased 7 million shares during the quarter. So it seems like the company had a pretty strong quarter with record operating cash flow for the first quarter, and revenue grew by 10% year over year. Then Adobe gave us their next quarter guidance and their full year guidance. So for the next quarter, they're expecting revenue to be about $5.79 billion, and for the full year, they're expecting about $2.34 billion in revenue. Now, on a quarter-over-quarter basis, this is only 1% revenue growth, which is pretty weak for Adobe. And on an annual basis, they're expecting about 9% revenue growth in 2025, which is also a lower growth rate than the company has been seeing over the past few years. So basically, Adobe is expecting their revenue growth rates to continue decelerating, which I do not think is a great thing to see. So let's head back over to Stock Unlock and take a look at some of Adobe's different metrics. And here we can see that revenue did hit an all-time high, and it's sitting at $22.04 billion in the trailing 12 months now. Free cash flow is also continuing to grow very strong and hit an all-time high of $9.19 billion in the trailing 12 months now. So now what I want to do is compare this 18.3 price to free cash flow versus Adobe's historical averages. And let's zoom in to about 2014, and we can see that its average is 33.7. And again, its latest value is about 18.5. So Adobe is trading well below its historical average price to free cash flow multiple. Now, what's also interesting is Adobe's price to free cash flow got down to about 18.6 in October of 2022. And for those of you who have been watching my channel for some time, you know that I was actually buying Adobe in this dip right here and this was after Adobe announced that it was trying to acquire Figma. I took advantage of this low price multiple for Adobe, and I ended up selling the stock at about an 80% gain over the next 6 months as the multiple expanded back to its historical averages. So now that Adobe's price to free cash flow is back to almost exactly where I was buying it in 2022, the question is, am I buying Adobe now? And the answer is no. I have not purchased any Adobe shares yet. And the reason is because over the past few years, I think that the developments in AI are continuing to weaken Adobe's moat. I have seen some pretty compelling videos and images just generated by different AI prompts now. So I think that Adobe's moat is actually being successfully attacked. And when I think 5 to 10 years out into the future, because this tech is still very new. So when I think 5 to 10 years out into the future, I could see AI video creation and AI photo creation becoming sort of commodities, which also sucks for me as a content creator because someone is probably going to be able to prompt my videos in the future. But what that ultimately means for Adobe's business is I think people are not going to want to pay $700 a year for Photoshop and Adobe Premiere Pro, which is what I currently pay, by the way. Like, if another company comes out and allows me to edit videos with prompts or allows me to create videos with prompts, then you can guarantee that I am not going to be spending $700 on Adobe products anymore. I'm kind of just waiting for it to get to that point, and I do think that it will get there eventually. So I guess what I'm trying to say is that over the past few years, I have watched these AI prompting video and image creators get better and better and better, and I think that this trend is only going to continue. So I don't know. I just feel like my conviction in this one is going down, especially with their revenue growth rates continuing to decelerate, especially as AI is absolutely booming. So Adobe does seem like it is losing some market share and maybe its competitive advantage. And that's kind of causing some hesitancy for me. Now, I also fully understand that opinions are subjective, and my opinion could be completely wrong. I also know that there's other people who think that Adobe's moat is incredibly strong and that they're not going to be disrupted by AI. So for those people, I did run some DCFs for you to kind of show you how Adobe stock could be looking arguably cheap today. So I did a reverse DCF calculation to show what the market is currently pricing in for Adobe stock, and it's currently pricing in 6.9% annual free cash flow growth for Adobe to continue buying back shares and to continue trading at an 18 price to free cash flow. And if Adobe can achieve this, then the stock could produce a compounded annual growth rate of 10%. Now, I also ran a DCF saying Adobe could trade for a 20 price to free cash flow, which I think is very fair, and continue to grow its free cash flow in line with revenue at about 9% annually. And if Adobe can deliver on this, then the stock could produce a 16% compounded annual growth rate. So if Adobe can continue to grow its free cash flows at 9% annually going forward, then the stock does look arguably cheap. So that's kind of my opinion on Adobe right now. I am losing conviction in this business. I think that its moat is being disrupted personally, but I also think that there is a very strong argument that the stock is looking undervalued, especially if their moat is strong and maintains, and the business can continue to grow its free cash flows. So that's my opinion on Adobe. At the moment, I'm not currently buying any, but I do see why people think it's cheap, and that's pretty much my opinion. Now let's move on to the next topic that I want to discuss, which is the valuations of Amazon, Google, Microsoft, and Apple today. So the metric that I am using is the price to operating cash flow because 3 of these businesses are going through a major CapEx cycle right now. So I want to take a look at their operating profits. And currently, Google has the lowest price to operating cash flow at 16, then it goes to Amazon at 18, Microsoft at 23, and Apple is in its own realm, selling for a 29 price to operating cash flow. So Apple is looking the most expensive out of these businesses by far. And I don't really understand why Apple is so expensive today, especially because it is actually the business growing the slowest. So in my opinion, I think that Apple is the most expensive company out of this group by far. And I don't think that it is looking cheap by any means. However, I do think that Amazon and Google are looking very cheap, and Microsoft I think is now selling around fair value. I actually think that Amazon is looking the cheapest despite it selling for a higher price to operating cash flow multiple than Google. And let me kind of explain this. Amazon's historical average price to operating cash flow is around 27, whereas Google's is around 18. Now, again, Google is selling for a 16 price multiple today, and Amazon is at 18. So Amazon is well below the company's historical average price to operating cash flow, whereas Google is only about 10% below its historical average. So relative to these companies' historical average multiples, Amazon is selling significantly below. Personally, I also think that Amazon's moat is stronger than Google's, and I think that Amazon is more set up over the long term to see operating cash flows grow. I understand that Google is a pretty polarizing stock today, but I just simply think that Amazon has a stronger moat, and therefore Amazon is the stock that I have continued to add to my portfolio and not Google. So I have been using this correction to continue adding to my Amazon position and buying some more shares instead of buying Google. I personally have been using Google search less and less, and I know that, Google's numbers are looking incredible and the business is continuing to grow well. But I have noticed in my own patterns that I am starting to ask AI and chatbots like Grok my questions before going to Google. And I've actually used Google to try and ask some questions, and then I don't see the results that I want. Then I go over to Grok, I ask it the same question, and I get exactly what I am looking for. So I'm not saying that this is going to cause Google's margins or anything like that to start going down immediately. But what I am saying is that as a consumer in the global marketplace, I have been noticing myself moving away from Google search more and more towards LLMs. And I am someone who is very hesitant to even try out language models and use them for anything. But now I am noticing that they're actually more efficient, and I'm just telling you guys the facts, okay? I have been using LLMs more than Google recently. I do still use Google for like Google Maps, or if I want to find a restaurant near me and I want to check the reviews or something like that. So again, guys, I'm not saying Google is dead, but I do think that their search monopoly is being attacked because I am a consumer and I am using LLMs more, and the people that I talk to are using them more. So I don't know if this trend is going to continue, and I think that's the main point I'm trying to make here, is I don't know. I don't know if this trend is going to continue with Google, and if it does, I don't know what that looks like for the business and its overall cash cow machine of Google search. And I prioritize certainty in my own portfolio. I have to feel certain about the investments that I invest in, because when I feel uncertain or when I feel uncomfortable, that's when I start to make emotional decisions in my portfolio. And I try to prioritize comfort when I am investing. So I think for me, the reason I am buying Amazon over Google is just because I feel so much more certain in the future of Amazon's business relative to the future of Google's business. Now, that's just me. As an individual, investing is extremely subjective, so I'm just sharing my opinion. And as I said before, I could turn out to be wrong, but I have to be honest with you guys, and I have to give you my opinion and share with you what I am currently seeing in the marketplace as well. So that's my opinion on Amazon, Google, Microsoft, and Apple. Apple is ridiculously expensive. No idea why it's trading so high. Microsoft, I think, is selling around fair value, and Amazon and Google, I think, are looking undervalued, but between the two, I have been adding to my Amazon position. All right, now the next thing that we have to talk about is a Financials Times article that came out about Brookfield Corporation, and it was a pretty bearish article, and the comment section of my YouTube videos has been lit up asking me to discuss this Financial Times article. So before we get into the article, I just want to let you all know that Brookfield is a pretty complex company, and I think that investors confuse this complexity as fraud, essentially, or distrust, or maybe not totally transparent. And what I've noticed through owning Brookfield over the past about 3 years now is these articles tend to come out every couple of months, or some YouTuber will make a video on Brookfield or private equity every couple of months and basically just go through the GAAP financials and say, these companies look like complete ass, honestly. So as a longtime shareholder of Brookfield Corporation, I just kind of wanted to let you guys know that this stuff is routine. It happens. It's going to continue happening. And I guess it's a good test of conviction, because when these articles come out, I do see a lot of people freak out, but I kind of just dismiss them at this point. Like, I do go through them, I do read them, but it's kind of just the same things over and over and over again. The general theme is Brookfield is extremely complex, so they're probably hiding things in their financial, they're probably doing some sort of fraud, and then people freak out, and then the stock and the business continue to perform well, and people ultimately forget about them until the next one comes out in a couple of months. So with that being said, let's go through the Financials Times article and share with you some of the concerns that were brought up. So in this article, it says, in July last year, part of a Manhattan landmark changed hands. A stake in One Liberty Plaza, the aging former U.S. Steel building that looms over a park once occupied by anti-Wall Street activists, was quietly purchased by a Texas life insurer. A rare transaction in a moribund market for office towers. It received little publicity because the building's ultimate owner, Canada's Brookfield Corporation, was both the buyer and the seller. One of the world's largest and most complex financial conglomerates, Brookfield sold property to itself like this dozens of times in 2024, using $1.4 billion from its insurance arm to finance transactions that supported its distributable earnings, a non-standard measure of profit that underpins the corporation's $90 billion stock market valuations. So in this first screenshot, the article is saying that Brookfield bought and sold assets to itself, and that they have done this dozens of times throughout 2024. Then they are scrutinizing Brookfield and saying that this $1.4 billion went towards the company's distributable earnings, or essentially its profits. So then I went and I uploaded this article to Grok, and then I started asking Grok about the article. And here's what Grok said. Brookfield does sell assets to itself, like moving a property from one part of the company to another, and counts the profits from these deals in its distributable earnings. For example, they might sell a building worth $100 million to one of their own funds for $120 million, pocketing a $20 million gain that boosts distributable earnings. This isn't illegal, and their financial reports admit that it happens, but it can make their earnings look stronger than if they had to sell to an outside buyer at a potentially lower price. There's no hard proof of fakery, and regulators haven't stepped in. It's less about outright lies and more about a system that lets them polish their results legally, leaving some analysts and investors skeptical. So first of all, this is not illegal, and you kind of have to understand how Brookfield works to understand what they're actually doing here. So first off, you have to understand that Brookfield has different funds that it raises with its institutional clients. For example, Brookfield will raise something like a $5 billion fund from its clients and invest this money over the next 10 years. Then at the end of the 10 years, Brookfield's investors want their returns, and the fund is essentially over. So what they'll do is they'll raise new funds and buy the assets in the existing fund at its fair market value, give the old investors their returns and their liquidity, and keep the asset in the new fund. Like imagine that Brookfield has a great piece of real estate that is currently owned by an existing fund. However, the investors in the existing fund want their liquidity and their returns, and Brookfield wants to keep its asset as it is still a great asset. So what Brookfield will do is they'll buy the asset from the existing fund, give the investors their returns, then the new investors and Brookfield will still own this great asset. This is essentially what is happening and what Brookfield is doing. Now, I also asked Grok if this is normal in the private equity markets, and this is what Grok said. Yes, other large alternative asset managers like Blackstone, KKR, Apollo, and Carlyle also engage in practices similar to Brookfield's, where they sell assets between their own entities or funds. In Blackstone's 2023 annual report, it shows $7.1 billion in distributable earnings, with realized performance revenues and realized principal investment income, partly driven by such sales. KKR does this too. Its 2024 Q3 results boasted $1.2 billion of distributable earnings, including gains from selling portfolio companies to its own continuation funds. Apollo's filings reveal similar moves, like shifting distressed assets to affiliated funds, while Carlyle has been known to sell stakes in portfolio firms to its own growth funds. These deals often use internal valuations, much like Brookfield, especially when market conditions are shaky or third-party bids are scarce. Critics, though, argue that this can inflate earnings, as internal pricing might exceed what an external buyer would pay. So what Grok is saying here is that this is normal in the private equity markets, and every other major private equity company does the exact same thing. The issue is if Brookfield is selling these assets to itself at higher prices than what they're worth in the public marketplace. So then I went to Brookfield's 2023 letter to shareholders, and here they say, during the year, we monetized over $30 billion of assets at strong valuations, substantially all transacting values at higher than our IFRS carrying values. So what this means is that in 2023, Brookfield sold $30 billion worth of assets, and they're saying that basically all of these asset sales were at higher valuations than what they currently have them at on their books. And this suggests that when Brookfield is going and selling its assets in the public marketplace to external buyers, those buyers are willing to pay higher prices than what Brookfield is carrying its assets for on the balance sheet. Then I went over to the 2024 annual letter, and here Brookfield writes, We recently announced the sale of a 49% stake in a premier office asset in Dubai at very attractive returns, underscoring the demand for high-quality real estate globally, and the long-term potential for this one-of-a-kind asset. We are progressing the sale of a hotel at our premier mixed-use complex in Seoul, Korea, targeting above returns on capital. And we are at the later stages of finalizing additional real estate monetizations. Substantially all sales were completed or are expected to be agreed at prices in line with our carrying values. Now again, why this is important is because Brookfield is selling its real estate to external buyers for prices that match the carrying values on the balance sheet. This essentially shows us that Brookfield is not inflating its asset values on the balance sheet and selling its assets at ridiculous premiums to itself, because external buyers are willing to pay those prices that Brookfield has on the balance sheet for their assets. So yeah, I think that this argument is kind of thrown out of the window. Now, additionally, in the Financial Times article, they also say, over the past 2 years, its funds have sold 192 real estate assets or portfolios to unrelated third parties for $27 billion at an average 3% premium to its accounting valuations. So the Financial Times articles itself, the one that is kind of being bearish towards Brookfield, does point out that over the past 2 years, they have sold 192 properties at an average of a 3% premium to the valuation that they have on the balance sheet. So the article itself is saying that Brookfield is not inflating its asset values on the balance sheet. And I think that, again, this kind of tells you that Brookfield's not really doing anything sketchy here, and this is normal in the private equity industry. The article then goes on to talk about Brookfield Property Group, and they say, the partnership lost $2 billion in the first 9 months of 2024. Its operating income did not cover its interest costs either. During this challenging period, it raised funds by selling real estate to Brookfield's insurance arm. Brookfield Corporation injected another $1.4 billion into the partnership as new equity. So basically what they are trying to say here is that Brookfield Property Group is losing money, and Brookfield Corporation therefore had to buy assets off of Brookfield Property Group to essentially give them money. And what this article is essentially trying to say is that they overinflated the real estate asset values to essentially inject capital into Brookfield Property Group. Then Brookfield responded saying there is nothing deceptive whatsoever, adding that these claims willfully mischaracterize our business and stand completely at odds with the facts. So what I did is I went straight to the source and I looked at Brookfield Property Group's cash flow statement. And here we can see that in the first 9 months of 2024, it generated about $758 million of operating cash flow. And then down here in investing activities, we can see that Brookfield Property Group spent about $284 million on property, plant, and equipment, which ultimately means that the company produced about $500 million in free cash flow so far in 2024. We can also see that BPY spent $5.8 billion on buying more investment properties. They used about $3.1 billion of debt to do this, and they also sold about $1.4 billion of real estate to acquire more real estate. But when you take a look at BPY's cash flow statement, you can clearly see that the company is producing positive free cash flow. And the reason they took on more debt and sold assets is because they wanted to acquire $5.8 billion worth of new assets. And this is ultimately what Brookfield's entire business does. This is called capital recycling. And what Brookfield does is they sell mature assets, and then they take that capital and they buy distressed or new assets that they then fix up and recycle capital that way. So this is just what the business does. And when I take a look at this cash flow statement, I'm not seeing an unprofitable business that's losing money that needs to inject capital back into itself to survive. What I'm seeing is a business that's selling assets and taking that cash flow and buying more new assets with it. And this is exactly what Brookfield does. So again, I don't think that there's any real merit here to the Financial Times article. Now, while we're on the topic of Brookfield, I want to show you a screenshot from their 2024 Investor Day presentation. So as of today, the company has about $25 billion worth of real estate. And over the next 5 years, they want to actually sell off $10 billion worth of real estate and only have about $15 billion left. Currently, they also show that their BPY group generates about $735 million of distributable earnings. And over the next 5 years, they're projecting this to decline to $525 million as they sell off real estate. So what's important to understand here is Brookfield actually wants to reduce its real estate portfolio over the next 5 years and move away from real estate. So going forward, the business wants to become less and less reliant on real estate, and the real estate portfolio is actually a small portion of the overall business now. Brookfield also showed that over the next 5 years, they are projecting to grow their distributable earnings by 25% annually, and only 2% of that growth is projected to come from their operating businesses. So the operating businesses are becoming less and less relevant for Brookfield, and the vast majority of the company's growth is going to come from its asset management and insurance businesses. These are really where the company wants to move to, and it wants these two businesses to make up more and more of the overall business. And these are the two main growth drivers of Brookfield. But what's interesting is every time I read a bearish article, it's always about the real estate portfolio. It's always about the real estate portfolio. Even though the real estate portfolio is projected to shrink, and it's becoming less and less relevant to Brookfield's overall business. But it's all anyone ever wants to talk about. And I think that, if the market wants to sell off Brookfield based on its real estate portfolio, then I'm going to be a happy buyer, and I'm going to continue increasing my position. So I wrote out a quick summary of my thoughts on this FT article. I have come to realize that owning BN means seeing bearish articles and videos come out every month or so. People mistake Brookfield's complexity for fraud, and this will continue to happen, and there's other YouTubers that will continue to make bearish content on Brookfield, and I am simply not going to respond to every single one of their videos, as I am not a reaction channel, and this is simply not worth my time. If you're going to own Brookfield, then you got to do your research, because this is not an easy one to own and understand. I personally am not going to get scared out by every bearish article or YouTube video that comes up, but it is a good test of your conviction. Now, additionally, management owns 20% of Brookfield Corporation, and 90% of their wealth is invested in the company as well. So if they're running a fraud or didn't believe in the company, then I don't think that this would be the case, because almost all of their net worth is directly tied to the performance of Brookfield Corporation and the business continuing to succeed. So that is my summary on the Brookfield Financials Times article, and that is what I think about it. So to wrap up this video, I now want to play a couple of quick clips from an interview that Bruce Flatt recently did with Bloomberg. And for those of you who do not know, Bruce Flatt is the CEO of Brookfield Corporation. And I think that this is a masterclass on investing and just a really good interview. So I'm going to play the clips and then we'll discuss it quickly afterwards.
A lot has been made recently, and certainly here over the past 2 days, about the amount of policy uncertainty and volatility. Those things can create opportunities too. Just yesterday, we saw BlackRock lead a $19 billion deal for control of a global ports business. And most notably, of course, that deal includes 2 facilities in Panama that the Trump administration had targeted because of their Chinese ownership. Is that going to be a trend? Forced sales, M&A driven by an urgent need, in this case, an urgent need for both the Chinese owners and the Panamanian government to get out of this administration's crosshairs?
Look, the price and value are 2 different things. The value is what you get, the price is what you pay. And volatility creates opportunity around the world for those that are strong and those that have capital to be able to take advantage of opportunities. And as long as you keep your eye on 20 years from now in the businesses that you're running, all of these things will be looked back upon as very short-term items. This will not be, what we're going through today will not be relevant 25 years from today.
But it might not be relevant beyond this presidential term.
I'm just telling you, 25 years from now, we're going to look back and it won't be relevant.
You're thinking on that time horizon?
We always think on those time horizons. Everything we do...
Not everybody here can afford to think like that.
Everything we do, or why we're in private markets, is because we buy things for long periods of time. And either we're going to hold them, or it's in a fund where we may have to sell. But what we need to do is to prepare the investment for the next owner that they will accept the next 25 years. And that's really, really important to keep your eye on the long ball.
All right, so that's the first clip from Bruce Flatt. And you can kind of see, like, this is an interesting interview because this is the first time that I've seen Bruce actually get slightly emotional, maybe a little bit more animated, and he does so more in the interview. But the first main thing that Bruce discusses in this interview is that price is what you pay, and value is what you get. And if you don't know, this is exactly what Warren Buffett says about value investing and investing in general. Then Bruce also says that in 25 years, what we're going through today with the Trump administration and tariffs and the global uncertainty is going to be irrelevant long term. It's what's in the news right now. Everyone is scared. Times are very uncertain. But in 25 years, no one's going to be talking about what is happening right now. So while the markets are so focused on the short term and focused on what's going on today, you can make investment decisions and take advantage of the uncertainty by making investment decisions that are centered around a long-term view or a long-term horizon. And that's exactly what Brookfield does. Then he goes on to say, the volatility is what creates opportunities. And I completely agree. If you've read the volatility chapter in my book, that's like word for word what I say. Volatility is actually what creates opportunities in the market. So when people are freaking out about the short term and things are being volatile in the short term, if you can maintain that long-term perspective and know that this stuff is just not going to matter in 10, 15, 20 years, then you can buy assets for discounts that are going to be just fine and continue to grow over the next 20 years. And Brookfield Corporation is one of the companies that I think will grow over the next 20 years. So I thought that was a great start to the interview. And now I have the next clip set up here. So let's take a listen.
I do want to take a minute and talk to you about AI in particular, because infrastructure is quite obviously to all of us becoming one of the gating factors in the growth of AI. Hundreds and hundreds of billion dollars being committed to AI infrastructure. Brookfield is a player. What's your commitment to date, and what role do you see yourselves playing over time?
So we are the largest private builder of renewable power in the world. We're among the top 3 largest builders of data centers in the world. And we're continuing to morph the model into funding compute capacity for the technology groups. The number one thing that stands between us achieving all of the models that will drive the AI revolution and productivity advances is the backbone of infrastructure around the world. It's the singular one thing. And so we continue to put enormous amounts of money behind these businesses. And it's largely because our view is that the productivity advances that are going to come out of AI models in advanced robotics and services are going to be unprecedented over the next 20 years. And what that means is we're in the midst, in the United States, but also globally, we're in the midst of this enormous investment era, but it's going into highly productive investment, which is going to lead to very significant productivity advances. We're talking 50 to 100% returns on capital, where we have seen deployment of some of these things on early test cases.
Does it matter where you are? Does it matter who you're partnered with?
Firstly, what's really important and why this is so exciting for our business is it's not if you have a model today, it's whether you have compute capacity, which requires data centers and power. And that's what's super, super important. And that's what's going to matter in the future. So we're spending, like, all of our capacity is committed for 20 years. We haven't even built some of it yet, but it's all committed for 20 years. We're entitling new sites around the world, but in particular in the US, which is going to be used for artificial intelligence models and learning. And this is very, very significant investment.
So there was a lot discussed in that clip, but the overall theme is that Brookfield is one of the major companies investing in the backbone of AI infrastructure. And one of the reasons why I like this personally as an investment is because I think Bruce said it very well. It's the one thing that is absolutely necessary for this technology to continue advancing, is you need the actual infrastructure, the literal power, the literal data centers, the infrastructure to have this technology continue to advance. So basically, if we want AI to continue developing and if we want technology to continue progressing forward, which we obviously do, then we're going to need a lot more infrastructure. And it's basically the limiting factor right now. As Bruce said, what these companies need is more power and more data centers. And Brookfield is, I believe he said, the third largest company globally, that is, or the third largest builder of AI infrastructure globally. He also said that their data centers are committed for the next 20 years, even the ones that they're currently building. So they have 20-year contracts for these data centers already signed, and all of them. So there's a rush, there's a massive rush right now for this infrastructure, and Brookfield is one of the largest companies in the world supplying it. So now let's move on to the final clip that I want to discuss, and this one actually will bring us right to the end of the interview.
Specifically about renewables, I know you listened to the State of the Union last night, I did as well. The president spent a fair bit of time talking about his achievements, among them, killing the federal EV mandate, bringing back drill baby drill to the oil industry. Does this, in your mind, pose a setback for renewables, to the energy transition, to transition finance, where Mark himself and Brookfield play an important role, and ultimately to decarbonizing the atmosphere?
So remember, oil is used in cars and planes. It's not used in power. We were always in favor of oil.
Gas is used in power, though.
Gas is used in power, and we were always in favor of gas because we need gas as a bridge fuel, and we're exporting it, and countries around the world need it to get rid of coal. Third, and this is really important, in the United States and in most countries of the world, solar and wind are the lowest cost power there is. When you have the lowest cost power, people buy it from you. Today, people just need power. They need any power. They need power from solar, they need power from wind, they need power from gas, they need power from nuclear, they need it from everywhere because we're going to double the electricity stack in the next 20 years. And it's impossible to get there without all of these. So I think what's being done today is smart, but it doesn't matter for renewables. It's all still getting built.
There's only one thing standing between us and lunch, and that is the last word from Bruce Flatt. Bruce, with somebody who looks at the world with a 25-year investment horizon, at a time when so many people, perhaps some of you in this room, might be uneasy, freaking out perhaps, about the state of things, what's the single most valuable piece of advice you could give them?
Stay focused on the long ball. Nothing else matters.
There you have it, folks.
All right, and that's the interview. So, yeah, in that last clip, Bruce was getting pretty passionate about renewable energy, especially with the Trump administration and them not sounding very optimistic or bullish on renewables. But Bruce makes a really good point. In a lot of economies around the world now, solar and wind are the cheapest form of power. So if you want power, that's actually your cheapest option. So the economic incentive is there, finally, for people to build and for countries to build solar and wind. And he basically is saying that this is not going to impact Brookfield's renewable business very much. Now, however, as I also showed earlier on in the video, Brookfield's operating businesses are not projected to be a large portion of the business's growth going forward. So it's probably not really going to be a material for Brookfield Corporation anyways. And then he wraps up the interview by saying, focus on the long term, nothing else matters. And as an investor, I completely agree. That's pretty much all I try to do on my channel and in my Patreon community. I try to take advantage of short-term volatility and short-mindedness in the market and buy businesses for the long term. Really all comes down to buying great, fundamentally sound businesses for the long term and getting them at good prices. So that's going to wrap up the video for today, everyone. I really hope you enjoyed it. If you did, please remember to leave a like. If you're interested in getting even more content from me, checking out my personal portfolios and seeing everything that I own, then make sure to check out my Patreon as well. My Patreon members have been absolutely loving the Patreon community, and I think that you will too. And if you're new here and you want to see more content like this, then please consider subscribing to my channel as well. But as always, thank you all so much for tuning in. I really do appreciate it, and I hope to see you all again in my next video.